Hi, my name is Brian, and today we will be using the StockCalc.com website to do a variety of valuation calculations for General Electric. The valuation modules are contained within the Research menu, which you can activate by clicking Research from the home page. You can see the Query, Backtest, Forecast, and Valuation modules. Click on Valuation to reveal the submenus. In this video, we are going to do a discounted cash flow, a capitalized cash flow, and use the comparables tool to take a look at General Electric. Let's start with the discounted cash flow. You can see there are two tabs, Advanced and Basic, and we will start with the Basic tab. We covered the Advanced in another video. Let's type GE in and select General Electric from the drop-down menu. There are a number of assumptions that have to be made in order to come up with this value per share calculation. The number of years that we're looking to forecast, the growth rate that we're forecasting those years, the tax rate which we take from the most recent financial statements, a weighted average cost of capital, which is the blended cost to the company of both raising equity and debt. In this case we have 8.114 calculated for General Electric. A measure of cash flow, and in this case we've used the most recent EBITDA from the financial statements, earnings before interest, taxes, depreciation, and amortization. We use these to calculate a value called enterprise value. So basically what we're doing is taking the cash flow, growing it out for the number of years, then projecting that back, discounted at the cost of capital, to come up with an enterprise value. We actually grow the company at 5% for 3 years and then do another calculation for years 4 and beyond. The interest-bearing debt is then removed from the enterprise value, and if any preferred shares exist, they would be removed as well. The result is referred to as the common equity. The common equity is divided by the number of common shares outstanding to give us a value per share. You can see the value per share that we've calculated here is significantly less than the current price of the company. We can use this tool to do a variety of what-if calculations. What if the WACC was 7% instead of 8%, for example? We see the value per share quickly jumps from $9 to $16. If we went to 6, the value per share would approximate the current price of the company. This current price is a 15-minute delay. So we can use this discounted cash flow tool to look at a variety of factors and see how they are impacting the value per share for the company. Let's move on to a capitalized cash flow. Again, we will type GE into the drop-down, select it. We will use an average value, but we could also use a weighted average value where we give more weight to the most recent years. We will look at this over the last 10 years for General Electric. And we will use our predefined WACC of 8.114. And as you can see, we would be able to adjust it. So from this, I can calculate the capitalized cash flow. The information you see here looks similar to the basic discounted cash flow that we saw on the previous screens, with the exception that we can do a number of adjustments or normalizations here. Things like sustaining capital, tax shields on that sustaining capital, any incremental working capital, if there are redundant assets in the company, or any other adjustments that are required. We will leave these blank for now. The EBITDA is our measure of cash flow for the company. We have the average for the last 10 years, as well as the low and high. We have the average tax rate for the period involved for the last 10 years, approximately 14%. Our weighted average cost of capital is inverted to create a capitalization rate. So in this case, our capitalization rate is 12 times, which is the inverse of 8%. That gives us a capitalized cash flow. And again, we can calculate our enterprise value from this. From the enterprise value, we remove any interest-bearing debt to give us a fair market value of the common equity. Divide that by the number of shares outstanding, gives us a value per share, as you saw in the basic discounted cash flow as well. The low over the last 10 years would have been, on these calculation basis, $6 a share with a high of $32 a share, again with this information. A capitalized cash flow relies on historic values. As you can see, there are no projections in this information. We're relying on the historic values over the period of time that we're dealing with. Again, we can do a sensitivity analysis. If WACC dropped 1%, for example, or the cost of capital, you could see the capitalization rate would increase from 12 to 14 times, and the value per share would go up to approximately $23 with a low from $11 to a high of $41. Again, another very useful tool. This uses historic values to figure out the value per share for the company. Finally, we will look at a comparables. The comparables uses companies that are in similar situation to the company that we're looking at, and we'll use their metrics to help identify the value of the company that we're looking at. So in this case, GE is in motor and generator manufacturing, and we're going to grab companies in that category whose close price is within 50% of General Electric's current price. We will add that criteria, and we're going to do this over a 5-year period. So we will grab any companies that fall into this sector and have this close price range over the last 5 years. With that, we can run the comparison. This comparison may take a couple of seconds given the size of the database. So you can see there are a number of companies that come up in the comparison. We have approximately 10 companies here. So we can select the first 5, for example. To free up some space, we can click the triple arrows and double arrows. So you can see 3 tables are generated as we select the companies above. The first shows the average values for our company: earnings per share, book value, sales per share, cash flow per share, and EBITDA per share. The lower box shows the average values for a variety of ratios for the companies that we've selected. So in this case, the average PE ratio is 19.21 for these 5 companies over that time frame. Price to book 4.49, price to sales 1.61, etc. We can see the price to cash flow ratio is actually quite high because we have one very significantly higher price to cash flow ratio and one that is quite high here as well. We could, for example, drop that company, recalculate, and regenerate the values. The way the values are calculated for the company that we're looking at is we take the average values from the company multiplied by the average ratio values for our comparables to come up with a price for the company that we're dealing with. So on an earnings per share basis, we would see approximately $15 per share for GE, 33 on a book value basis using our comparable companies. Sales per share, so on a price to sales ratio, we would get $17. On a cash flow, we would be at 196. Again, we have one very high value in here. And on an EBITDA basis, we would be showing 3. We actually have one value that's negative on an enterprise value to EBITDA ratio basis that's dragging down that valuation. Again, a very powerful tool that allows you to take a look at a variety of comparable companies to see how they factor in and allow us to calculate the value for the company that we're looking at. Please feel free to contact us if you have any questions, and we thank you for your time.